Hello and welcome to TEI's and Mayor Brown's presentation. Every 10 years, I have to relearn Section 382. I am Shiukay Hung, your host for today's presentation. Joining me today are Mayor Brown tax partners, Tom Humphreys and Remo Reigersman. Tom, would you like to say hello to the audience?
Hello, everyone. Tom Humphreys here from Mayor Brown, New York office. Really looking forward to the presentation today.
Thank you, Tom. Remo, would you like to say hello to the audience?
Hey, yeah, this is Remo Reigersman. Hello, everybody. Thanks for joining, and we look forward to this session.
Thank you, Remo. Before we get started today, 3 small housekeeping items to bring to your attention. First, please note that your audio line is going to be muted, but if you have any questions during the presentation, we do encourage you to use the Q&A feature in the chat box. Time permitting, we'll address some of these questions at the end of the presentation. Second, if you're watching this presentation live, you're lucky. You get to earn both CPE and CLE credits. If you want to earn CPE credits, we will have 5 polling questions during this presentation. It is very important that you answer all 5 polling questions in order to get your CPE credits. To earn your CLE credits, we'll be giving 2 alphanumeric codes throughout this presentation. Simply record those codes and complete your CLE form and return it to Mayor Brown. Third and the last point, no legal presentation can be complete without a disclaimer. As per our customary policy, the views expressed here in this presentation are the personal views of the speakers and are not the views of their respective firms or companies. Now, with that out of the way, let me now introduce our chair of TEI's New York chapter, Marina Solove, to give a welcome address. Please skip to slide 3.
Thanks, Shiukay. On behalf of the Federal Committee of the New York chapter of TEI, I want to welcome everybody to our program. Every 10 years, I have to relearn Section 382. We have over 200 registrations for this program, so you are all in very good virtual company. I want to thank Mayor Brown for graciously hosting the program, with special thanks to our speaker, Tom Humphreys and Remo Reigersman, and to Shiukay Hung from our own Federal Committee for moderating the panel. TEI has been around for over 70 years, and its mission of improving tax rules and their administration remains as relevant today as ever. At the New York chapter, we are committed to continue to bring you exciting programming, including an upcoming symposium that will be held virtually, and to provide you with opportunities to connect with other like-minded in-house tax professionals. If you are not already a TEI member, I want to encourage you to check out our website and LinkedIn page to learn about all the benefits that a TEI membership can deliver. Thank you and enjoy the program.
Thank you, Marina. Let's skip to slide 4 now and review the agenda together. Boy, we have an exciting and interactive program today, guys. We have 3 topics. First, we'll go over the basic rules of 382, go over some of the exceptions under 382L5 and the valuation rule under 382L6. And lastly, we'll go over some other limitations on NOLs and NOL usage, incorporating changes from the TCJA and the CARES Act. Throughout the presentation, to make this interactive, we'll have polling questions, so audience participation is greatly appreciated. Let's now jump to slide 5. The first polling question is an easy one. Which part of today's presentation is most relevant to your practice? Let's jump to slide 6 now. And Tom, can you lead us through the basic rules of 382?
Sure, Shiukay, happy to do it. Now, as you've heard, the title to this program is Every 10 Years, I Have to Relearn Section 382. Now, this is obviously a title that only has meaning for tax professionals, but it captures how we all feel about Section 382, which is the limitation on the carryover of net operating losses. Now, deep knowledge of this section is usually reserved for bad economic times when corporations are losing money. Now, before the pandemic, to me, that was the financial crisis. Then we all focused on large financial institutions with massive tax losses. Remember Washington Mutual, anyone? $6 billion in losses, as I recall. We'll hear more about that a little later. It took several years to work through those financial crisis losses. But then we tax professionals turn to other things, for example, the Tax Cuts and Jobs Act. Now, today, unfortunately, the economic losses caused by the pandemic have caused us to refocus on Section 382. And what we thought we could do is remind everybody how it works, see what changes in the law have occurred since the last time we learned it, and show you some techniques that have emerged over the and let's just start out with the basics. Section 382 imposes a value-based limit on the ability of a loss corporation, defined term, to offset its taxable income after an ownership change. I'll read that again. Section 382 imposes a value-based limit on the ability of a loss corporation to offset its taxable income after an ownership change. Now, as we always do, we want to remind everybody, well, why is this rule in the Internal Revenue Code? And so for that, look at the first bullet point. There's the legislative history from 1954, the Tax Reform Act of the Internal Revenue Code of 1954. And so you see there what Congress was concerned about, and Congress felt it was inappropriate to allow one corporation, which would be an acquiring corporation, to use the losses of a target corporation where the acquiring corporation had not basically participated in losing that money. And what do we call that? We call that trafficking in losses. And you'll hear that a lot when you talk about Code Section 382. It's designed to prevent trafficking in losses. Now, what does it apply to? That's the next bullet point on the slide. Net operating losses primarily. Nowadays, Section 163J carryovers. And also, never forget, when you're thinking about Code Section 382, never forget about a couple of other code sections, Code Section 383 in particular, which is a companion provision, and then Section 384, which deals with some certain special acquisition situations. So as you see on the slide, if there's an ownership change, pre-change losses, so losses up to that ownership change, are subject to an annual limit. And the limit is based on a percentage of the value of the corporation's equity. And that limit applies to those losses forever, unless they expire, and those would be pre-TCJA losses, or are used up. All right, so let's go to the next slide, slide 8. What's an ownership change? We have to have a change of stock ownership by more than 50 percentage points. So that's how we measure, we sort of distinguish, well, who earned the losses, who lost the money, and now who's going to attempt to use them. And when there's that 50% ownership change, then the limitation under 382 will kick in. Now, a couple of technical items here, but very important. We only count 5% shareholders. So we look at the 5% shareholders, and smaller shareholders are often something called a public group. We'll hear more about that later. But 5% shareholders. Now, as you may know, there are SEC reporting requirements that go along with being a 5% shareholder. And so, that is one reason why those folks are relevant. You can actually see if somebody goes above 5% in a public company, you should be able to see that in their SEC filings. What we do is we look at that ownership shift among those 5% shareholders. So we look at the percentage they own on the testing date versus the lowest percentage that 5% shareholder had at any time during what's called the testing period. Now, that's going to be 3 years, generally speaking, unless you've had a more recent ownership change. So we look at each 5% shareholder, how much did their ownership change, and we add all those folks up and ask, is it more than 50%? For these purposes, and we've got some more slides on this later because unfortunately, the various provisions we're going to be talking about look at stock ownership differently in different amounts and in different ways. What do I mean by that? Well, for these purposes, stock doesn't include what we call vanilla preferred. So that's stock that's generally non-voting and non-convertible and non-participating. So we exclude straight preferreds thought to be too debt-like, and therefore we do not count it in our 382 calculations. All right, let's go to the next slide.
Well, thank you, Tom. Let's now go to our second polling question. This is a simple one, not as easy as the last one, but I think it's still relatively simple. We have a corporation with NOLs. The only classes of shares outstanding is common stock, and you can see that shareholder A owns all of the common stock. In this transaction, common shareholder A is going to transfer 60% of its common stock to common shareholder B, such that after the transaction, the ownership is split 60-40 between A and B, as you can see in the after picture. The question at hand here is there an ownership change within the meaning of Section 382? As you complete the polling question, I'm going to invite Tom to explain the solution.
Thanks, Shiukay. Well, I hope I got that one right. I may not get the other ones right, but I think I got this one right. So notice that before the acquisition of stock by B, A owns 100% of the company. And so that company is a loss corporation, as shown in the slide. So one way you can have an ownership change is if A sells to B. And so since B acquired 50%, more than 50% of the stock, then that would be an ownership change. And the loss corporation's net operating loss carryovers would be limited under Section 382. And the way we do that, as we'll see, is to look at the value of the stock immediately after the ownership change. So that's one way you can have an ownership change, is just have a new shareholder acquiring shares of an existing shareholder. Now note here, B started out with 0 shares. So B was not a 5% shareholder, but obviously once it acquired 60%, then it was one of those people we count a 5% shareholder. Now another thing that might happen, let's say that instead of B acquiring from A, B acquired the stock from the loss corporation. And that too could trigger an ownership change, because B's percentage of ownership, again, would have popped up above that 50% limit. So pretty basic slide. Hopefully we got a very high percentage of correct answers. But with that, that's the answer to the question. Shame on you people who waited for me to tell you that before you push the button. But let's go to the next slide. And now what we're going to do is turn it over to Remelt. And Remelt's going to tell us a little about the testing dates. When do we worry about Code Section 382?
Yeah, so testing date, there's all these different, I guess, defined terms and terminology. And so the testing date is the date on which we look to the different ownership to decide, to determine whether that 50% change has happened during that rolling 3-year period. And so a testing date is any date on which there's a change in stock ownership affecting a 5% shareholder. So that's that first sub-bullet. And in this respect, it's important to keep in mind that that can be both an upward change or a downward change. So if a 5% shareholder, so let's say shareholder owning 6% goes from 6% to 7%, that'll be a testing date. But somebody going from 6% down to 5% would also be a testing date. And then in addition, a testing date is any tax-free reorg with an exception of the ones listed there, D, G, or an F. Now, you can imagine, obviously, public companies or potentially certain private companies, trading of stock. And so that happens almost on a daily, or in a public company context, obviously on a daily basis. Private company, there could be frequent transactions of stock. And so it doesn't necessarily mean that that is a testing date every single time. And the reason for that is because of the way the 5% shareholder limit is set up, because small shareholders are essentially aggregated into a public group. and you look at that public group as a blob, essentially, in terms of changes. And so the trading within the public group is not a testing date and doesn't have to separately be tested. So all the trading, if somebody goes from 0.1% up to 4.9%, that's not a problem, et cetera. That is all ignored, essentially, for 382 purposes. The other thing I'll just mention is, in the context of 382, there are a lot of exceptions. I would say the regulations are lengthy and complicated, and there's lots of little nuances and tweaks. For example, I think Tom mentioned on the earlier polling question example, if B purchases directly from the loss company, how that can also be result in an ownership change. And so, but then there are certain exceptions for like a cash issuance. You might calculate it differently, or you might not count the change by as much. So just keep in mind that anything involving 382 kind of requires a relatively detailed review of the regulations and making sure there are no exceptions or how the exceptions work. Okay, so let's go to the next slide, where the question is, okay, if 382 kicks in, if there is an ownership change, what does this mean? How are the NOLs limited? And so the limit is an annual limitation. It's an annual limitation on the use of NOLs that existed before the ownership change. And the limitation, that annual limitation, is equal to the product of the loss corporation's equity value on that testing date, multiplied by the long-term tax-exempt rate. The tax-exempt rate for November is put down there, so it's 0.85%. So that's pretty low. Now that's obviously an effect of or derived from the fact that we're in a low interest rate environment right now. A number of years ago, that might have been, let's say, 4% or something like that. But the main issue is that if you've got a company worth 100, or if the equity is worth 100, you multiply that by the 0.85%. That's the piece of the NOL that can be used in an annual per annum. An unused portion can be carried forward. So if the annual limitation is 50, you use only 45, 5 will be carried forward to the next year, et cetera. But you cannot use more than the annual limitation. There's no like carry back principle or anything like that in terms of limitations under 382. Okay, let's take a look at the next slide. So the limitation applies to post-change years. So it's a limitation on NOLs existing on the ownership date. So pre-change year NOLs are limited in post-change years. Now, obviously, a change in ownership, doesn't miraculously happen at year end or any other convenient date, right? June 30th in the case of a calendar year taxpayer, or end of a quarter. It can happen on any day of the year, essentially. And so the question becomes, how to run the calculations if the change doesn't occur, at year end. And so the default method is that you allocate income and loss pro rata, and you allocate it between the pre-change portion and the post-change portion of the year. And so it's a post-change taxable income that is subject to a modified 382 limitation to take into account the shortened period. So you essentially take into account the fact that you're not dealing with a perfect year. So if it's let's just say hypothetically a perfect 6-month period, then you just look at 50%. Alternatively, so it's a different method than the default method is making an election to close the books as of the change date. And so what that means is that you have to carefully plan. And there are examples in which this is used to a taxpayer's benefit or a loss company's benefit. And one example would be, if you have a big event, like a big worthless stock deduction or something like that. So you're not dealing with a company that loses money by selling widgets, let's say, at a loss, but we're dealing with a company that takes a one-time charge, like a worthless stock deduction, where it all of a sudden becomes quite important where, at what point of the year is that loss taken, and how does that compare to when an ownership change took place. And depending on, where those things fall and what side of the line we're on, it makes a difference whether you look at the default method of calculating or at the alternative method, or whether you want to make the election or not. And so there are examples in the public markets where this made a difference, and people have used it to their advantage in terms of planning. So let's look at the next, or I guess that's Shiukay, the next polling question.
Thank you, Remo. Thank you, Remo. So for the third polling question, we have a corporation. We're going to assume that an ownership change has occurred. And further, we're going to assume that the size of the annual limitation is $100 a year. In the first carryover year, the corporation has no taxable income. The question is, what is the size of the limitation in the next year then? As you're filling out the polling question here, I'm going to ask Remo to explain the solution.
Sure. So, so it's an annual limitation of 100 a year. And as we said earlier, if you don't use it in a particular year, you don't use up the full amount that you are able to use, then the leftover piece gets carried forward to the next year. Now that is subject to, I guess, the NOL being available pursuant to other code provisions. So it's subject to any other limitation, including expiration, and we'll get into that in a little bit. But so here, the full 100 has not been used, or not been used at all. And so the next year, there's a new annual limitation of 100, and then you add the unused piece from the prior year. And so 100 plus 100 is 200. And so the right answer should be B, 200. Okay, with that, next slide, I think I'll turn it back to Tom for some more 382 rules.
Okay, thanks, Remo. How are those answers coming in? Oh, okay. 54% for B. 35% for A. Okay. Continuity of business enterprise. So let's say you've accomplished your acquisition, and I don't know, let's say that the target, immediately after the transaction, the ownership change, there's a really high equity value. And so you think that you're going to get a very, very high limit under Code Section 382, except what the business people and the corporate lawyers, without telling you, blow out all the assets of the corporation a couple of months later. And you can imagine that doesn't work. And you see on the slide why, because there's a continuity of business enterprise, a requirement. So that requirement is that the corporation, after the change of ownership, continue the business enterprise for 2 years. And if you don't, then the 382 limitation becomes 0. So that's important to remember. It's an unusual set of facts, obviously, but as usual, it's the time when it happens that it will bite you. Fortunately, on this one, if you deal in the reorg area, you know about the COBE requirement there. And so we use the same test under Code Section 382. We either have to have historic business continuity, So the significant historic business of the pre-change corporation has to be continued, or we have to have asset continuity, which is use a significant portion of pre-change assets in the continuing corporation. We know there's a lot of gloss under the 368 reorganization rules on those provisions and numerical tests and good stuff like that. So that's where to look. Now, if we go to the next slide, built-in gains and losses. Okay, so it wouldn't take you long knowing what we've just told you about Code Section 382 to say, well, why don't I do this? I've got a bunch of loss assets in my corporation. I'm going to undergo an ownership change, and I'm just going to let those assets sit there. But after the ownership change, I'm going to sell them out, and I'm going to trigger the losses. And those were not pre-change losses, and so I can use those on an unlimited basis. I can use those losses. Answer, no. Those would be built-in losses, and built-in losses are subject to the same limit, the 382 limit applicable to the corporation. So there is a under Code Section 382, a very complex set of rules designed to figure out whether you have built-in gains or built-in losses. And the thing I'll tell you, we have a couple other slides on these provisions, but the thing I'll tell you is the rules were really designed for, if you look at that last bullet point, looking at the fair market value of the corporation's assets over the tax basis, which is never all that easy because value is a tough thing. But generally speaking, these rules were designed to and work okay when you talk about that situation, either built-in gains or built-in losses on assets. They don't work so well on other items. Think like potential cancellation of indebtedness income. The debt of the corporation, for example, is devalued. What happens when you trigger that COD either before or, in this case, after the ownership change? So if we go to slide 16, you see there the operative rules. If you are at a built-in gain position, then if you have realized built-in gain within 5 years, that increases your Section 382 limit for that year. If you are in a built-in loss position, then any realized losses, so you realize you sell that loss asset, within 5 years is treated as a pre-change loss. And there are presumptions, as you can see on the slide, designed to make it harder for the corporation to show it has gains, which increase the limit, and easier for the government to show that you have losses that were triggered within that are new bills within the 5-year period. Notice that 5-year period, if you just sit and wait for 5 years, then the realized losses after that point would not be subject to this limitation. Let's go to the next slide. Now, anytime you've had anyone who's had to deal with these sorts of issues, trying to figure out on, after an ownership change, am I in a built-in loss or built-in gain position, knows it's not all that easy when you get to various types of strange items. And so there is a guidance here. You see it on the slide. Notice 2003-65 for many, many years was the operative guidance in this area. And it adopts basically, or allows taxpayers to adopt two methods. The 1374 method, that's coming out of subchapter S, when a C corporation elects S status. And you can see on the slide the various pieces of that. What I'll tell you about the 1374 method is it's designed to basically look at, items that accrued or had accrued as of the change date. And so think accrual method of accounting, same sort of concept. We're trying to figure out or trying to identify items that economically have happened before the change date happened in the way that they would accrue if, it was a tax accounting problem. So that's the 1374 method. If we go to the next slide, the other method is the 338 method. And so that asks, well, what if, right at the change, there had been a 338 election and you triggered all the gains and losses in the assets? And you see there the elements of that. These are two different methods. When you first read them, you think, well, what's the difference? They are two very different methods, actually. And depending on what kind of item you're looking at, you will either benefit or suffer a detriment as a result of the method you elect. Now, was one in September of 2019, the government issued proposed regulations. And these regulations are basically designed to supplant the notice and come up with one method for figuring out built-in gains and losses. That method is the 1374 method. So the 338 method lost out in the regulations. But you got to be a little careful, and you got to read those regulations very carefully, because for certain items, think like cancellation of indebtedness income, it's not a pure accrual methodology. The government, where it felt necessary, tinkered around with a pure 1374 method to get to what it thought was the correct result. So beware, those proposed regulations are out there. Now, in terms of effective dates of those regulations, once they're finalized, there is some ability to use those regulations currently, again, if you do it consistently. But also note that in January of this year, the government clarified some of the transition rules and how the old notice and the new regulations, how they apply or could apply at a taxpayer's election to a particular ownership change happening before the regulations become final. So when you're trying to pick a method, look very carefully at that effective date to make sure you're allowed to pick the method that you want, to pick the method that would help you the most. Okay, so that's built-in gains and losses. I'm going to turn it back to Remo now.
Thanks, Tom. So we're going to talk a little bit about the 382 L5 exceptions. There's two exceptions, L5 and L6. Now, if I'm remembering the polling question at the beginning correctly, I think the L5 exception might have had the least number of votes, which makes sense. Because 382 L5 is really for a company that's in bankruptcy and is coming out of bankruptcy, and hopefully, you're not in that category. But I will, the other. So L5 is of more interest to companies in bankruptcy. I will also say, though, that although not frequent and somewhat rare, 382 L5 can be used as a planning opportunity. So there have been transactions done where NOLs had to be preserved, and a company was put into bankruptcy for obviously other reasons too, but in part to ensure survival of NOLs, or at least use of NOLs without limitation going forward. So, all right, so let's look at 382 L5, and basically what it says is that there's no 382 limitation with respect to an ownership change if that lost corporation is in bankruptcy and shareholders and old and cold creditors, and we'll get back to exactly what that is, but the group consisting of shareholders and old and cold creditors own at least 50% of the corporation after the ownership change. Technically, an ownership change does occur because there is more than a 50% change in the equity. So it is an ownership change. It's just that there's no limitation on the use of NOLs. But because there's an ownership change, technically, the 3-year rolling period that is used to determine future ownership changes restarts. So in other words, you're restarting with a clean slate. Again, something to keep in mind because it's a relatively powerful planning tool around bankruptcy and bankruptcy exits. There's an interest haircut So NOLs are recomputed to disallow interest deductions related to debt that's converted to equity. So if, as part of the bankruptcy plan, debt is converted into equity, and those creditors who owned that debt are old and cold, and they count towards the 50%, that's helpful on the 382L5 side. In addition, and this is not limited to old and cold creditors, but so all the debt that's converted into equity, the interest is disallowed. It's disallowed for, I think it's the current year, so the year in which the ownership change occurs, which is the bankruptcy confirmation year, essentially, the date in which the year in which that date falls, plus the 3 preceding years. So it'll be 3 years and a portion of that other year in which the plan is confirmed, in which the interest is disallowed. And so obviously that typically has the effect of reducing the size of the NOLs to some extent. Now, I mentioned Tom had a discussion about the COBE requirement. And so that requirement is turned off. In the regulations, there's a provision that says that the COBE requirement does not apply. No need to continue the historic business of loss corporation in connection with an L5 plan. And so what that means is, as we'll see a little bit later, you might still need a business. It just doesn't have to be the historic business. Again, an important point for planning opportunities. And then finally, the last bullet here, if another ownership change occurs within 2 years, so that's within 2 years of an L5 plan, the 382 limitation becomes 0. So in other words, if there's an ownership change within 2 years, it's not the case that you then look to equity value times the long-term tax exempt rate to come up with the NOL limitation for that year and following years. It's just deemed to be 0. So essentially, the NOLs are wiped out. Now, people, obviously that's a pretty big deal, right? I mean, you go through an L5 bankruptcy plan, you work to preserve NOLs, and so if something then bad then happens within 2 years, the NOLs are wiped out. That's something all stakeholders really want to avoid. And so one way in which that is typically addressed is that as part of the bankruptcy exit, the articles of incorporation or the certificate of incorporation of the loss company is redrafted, it's redone, and you can put some limitations in there in terms of stock trading, stock transfers. And so you would put in a provision that says you cannot become a 5% shareholder. You can't gobble up more stock that makes you a 5% shareholder without board approval. Or if you are already a 5% shareholder, you can't buy more without board approval. So there's things you can do to protect the NOLs and avoid the NOLs from essentially going to 0 if that subsequent ownership change would happen. All right, let's look at the next slide. Old and cold creditors, so the qualified creditors. So there's really two categories. I would say the real old and cold creditors, or so maybe there's 3 categories actually. So actual old and cold creditors is creditors who acquired their claim vis-a-vis the debt corporation at least 18 months before the bankruptcy. This is an important point because, bankruptcies can take a while to work out in court and be resolved in court. But this 18-month date looks to the bankruptcy filing date, not the bankruptcy exit date. So if you have, let's say an 18-month bankruptcy, to pick a number, then, buying a month before bankruptcy doesn't help. So it's looking at 18 months before the filing date. Also treated as old and cold creditors are holders of claims that arose in the ordinary course of a trade or business. There's some language in the regulations and 382 regulations on this, but generally, rule of thumb is if the claim would have been deductible. So if the payment by the debtor corporation to the holder claim would have been deductible, like a 162 ordinary business expense, for example, that would be an ordinary course debt, or the holder claim would be an ordinary course claim holder. And then the third category is essentially creditors, claim holders who become shareholders as part of the plan. So once the dust settles, they now own stock in the company. Their claims were settled by the issuance of stock. And they own less than 5%, they are deemed old and cold. So what this essentially means is we're not going to track everybody. We're not going to try to figure all this out. So if you end up with less than 5% of the shares, you're going to be treated as a deemed old and cold creditor. Now, you see there the last two bullets are exceptions to keep in mind. So if you are, or if there's a creditor who participates in formulating the bankruptcy plan, and as part of that participation, it becomes evident to the debtor or the loss company that the creditor is not truly old and cold. So the debtor is not an 18-month holder from before the petition date, then you can deem that creditor to be old and cold. Now you have actual knowledge. And then in addition, the other rule at the bottom of the slide is if the loss company has actual knowledge of a coordinated acquisition by a group of people or entities, then the group is treated as a single person. So, for example, if you've got 10 people working together and they all buy they all buy claims that end up with 4.5% of the stock, they might think, aha, now we've got 45% afterwards. But if that is a coordinated effort and the loss company knows about it, then you're going to aggregate them and treat that as one 45% holder who, if they haven't held it for at least 18 months, you then cannot shoehorn them into the deemed old and cold less than 5% grouping. And so, when you see this or hear this, I guess what's bubbling up to the surface is careful planning is very important. What information do you share? If you are a creditor, what information do you share with the loss company? And if you're a loss company, what information do you really want to know from the creditor? Because depending on how it's structured and what is communicated in term sheets or restructuring agreements and plans, that can have an impact on how you count for 382 L5 purposes, and therefore which losses are or are not preserved. All right, let's go to the next slide because what all this means is a debtor often realizes, I have NOLs, I'm filing for bankruptcy, I've got NOLs, and those NOLs have value. How do I preserve that value? As we just went through, small creditors are good, old and cold creditors are good for purposes of L5. And so what you want to avoid is trading in claims. Those claims ultimately get converted into equity, and by virtue of that trading, that NOLs might be limited in their use going forward. For example, the claims got gobbled up by a few large hedge funds or investors. Now you're no longer eligible for L5, and the NOLs are limited in their use and therefore limited in their value. And so there's such a thing as a trading order. So a debtor will go to the bankruptcy judge and say, I'd like you to enter a trading order which can help me preserve my the eligibility for an L5 plan and therefore the value of my NOLs. And so there's different ways in which these plans get implemented. There is a form, there's an LSTA trading order form that people use. And the flavors are, you can say nobody can buy anything unless you get approval. Or you can say you can trade whatever you want in terms of claims. It's just that once we start formulating a plan and that plan results in a particular creditor owning too much of the equity, then we can tell them you got to sell some of your claims to push them down below 5%. So that's typically how the orders will work, is to make sure that once the bankruptcy petition is entered, that claim holders can't start buying up claims and busting 382L5. So let's, with that explanation, let's go and look at the polling question.
Thank you, Remo. So we're now onto our third polling question, or rather, sorry, we're onto our fourth polling question. You will see we have a corporation here. It has filed for bankruptcy protection. It has various claims that is under. Happily, everything here add up to 100, which makes the math a little easier. We have a $20 of trade creditor claim, so that sounds fairly simple. We're at $30 of claim from distressed debt fund number 1. So query, how did the distressed debt fund get those claims? And then we have another $30 of claim from distressed debt fund number 2. And then we have separately 20 separate $1 claims from note holders. So in satisfaction of these claims, the creditors are now going to be issued stock in the lost corporation. The question is, will NOLs be limited under Section 382 pursuant to this plan? As you're completing the polling question, I'm going to ask Remo to explain the solution here.
All right. So I guess it's a little bit of a trick question. So pro rata ownership of the organized debtor. So that means that there's going to be $100 of equity post reorganization. The trade creditor, remember, a trade creditor is considered a good creditor for L5 purposes. And then, so that's the first arrow there at the top. The bottom arrow, 20 times a $1 claim. So that's a small holder, right? So that note holder, when he or she converts to equity, that's a $1 or a 1% interest. That's less than 5%. So that person is deemed old and cold. So let's add up the $20 claim and the $20 small creditors, and now we've got $40 of old and cold, or qualified creditors, I should say. And so to fit in the 382L5 category, we need to have 50% or more held by prior shareholders plus qualified creditors. Now here, there's no prior shareholders. They're all wiped out. And so it looks like the answer here is L5 does not apply. So NOLs will be limited. And so the answer's number is A. Now, obviously, that assumes that the distressed debt funds are not truly old and cold, and that the distressed debt funds did not buy their claims at least 18 months before the petition date, right? If one of them did, then you might end up in answer B. But typically, distressed debt funds, from our experience, start trading in the debt, once it's a little bit closer to bankruptcy than 18 months, although not necessarily the case. So, that again, a point that would, that needs attention and diligence, if and when it becomes relevant. Now, I'm going to turn it back to Tom with some spiffy thoughts on how L5 can apply in uncommon situations.
Okay, thanks, Remo. So to those, and I know we spent a lot of time on Code Section 382L5, but to those, and to those outside of the bankruptcy world, it's not often understood how powerful a code section that is. To those who have had the privilege of getting deeply involved in bankruptcies, whether that's a privilege or not, who knows? But you notice that from a tax standpoint, this is one of the things that taxpayers are always going to focus on to try to see if they can preserve their losses and use them after the bankruptcy. At the end, the next question you guys are going to want to ask is, well, can you really use those losses? And the answer is yeah, although it's not easy, and we'll talk about that at the end. So now, once in a while, someone will come in and say, I can't do a 382L5 plan. I've looked at all my creditors, and they just don't stack up right. And think of the prior slide, think of the polling slide, where we had a couple of big distressed debt funds, and we suspected that they were not old and cold, and they owned 5% or more of the claims. So if you ever get that question, always think about this particular structure as a way to 382L5. Doesn't always work, but at least think of it and see whether it might work in your situation. So what we've got is our corporation, and that's our loss corporation with the NOLs. And we've got a group of old and cold former creditors off on the left. And those, for example, would be our less than 5%ers. And so, unfortunately, just the way the credit holdings stack up, those folks don't own more than 50% of the corporation, and they won't own after you turn their claims into equity. On the right side of the slide, we've got our large former creditors. And so those are those distressed debt funds. And we don't think that they're old and cold, and they're going to get more than 5% of the equity in the reorganized company. So one thought that comes to mind is let's split up the consideration that those folks receive, those large former creditors. What we'll do is we'll give them a combination of stock and something else. So how much stock are we going to give them? This should be a polling question, but it's not. We're going to give them an amount of 4.9% of the reorganized company's equity. So we're going to keep them under that 5% limit. And that's all they can get. Each one of those folks, you cannot get more than 4.9% of the reorganized corporation's equity. That then turns them into small creditors, and they are deemed to be old and cold. And as a result, before long, you'll pop over that 50% limit because the old and cold creditors, including small creditors who are deemed to be old and cold, will end up with more than 50% of the corporation. Of course, those large former creditors don't want to give up their claims for a limited amount of stock. And that's where OpCo comes in. So what's OpCo? So the way this structure would work, in a perfect world, the corporation takes all of its assets and puts them into OpCo. Okay, OpCo is what? A partnership for federal income tax purposes. The next thing that happens when you reorganize the company, the interests in OpCo are going to be given to the large former creditors, a lot of the interest in OpCo. So when the smoke clears, the corporation will be a partner in OpCo, as will the large former creditors. So what have we done? Well, now we've used the OpCo, and you may recognize the term OP units. You may have heard of UPREITs or UP-Cs. Well, what you're doing is an UP-C transaction inside a bankruptcy to try to hit the mark on Code Section 382L5. So we'll give those OP units, those are the partnership interests in OpCo, and we'll give those to the large former creditors. And if I'm a large former creditor, when I look at the consideration I receive for my claim, it'll be stock, 4.9% max, and OP units in OpCo. And so that's a way to expand the ambit, as it were, of Code Section 382L5. Now, don't think this is like an UP-C, exactly like an UP-C, because those OP units that the former creditors get cannot be convertible back into the stock of the corporation. In a standard UP-C transaction, the OP units are convertible into the stock of the corporation. You can't do that here because we worry about attribution rules and option attribution rules. I noticed a couple of questions in the question box. One is basically asking, well, do attribution rules apply under Code Section 382? And the answer is yes. There are attribution rules. You should take a look at Code Section 382 L3 Cap A. 382 L3 Cap A deals with constructive ownership. And so you have to be mindful of those rules. The constructive ownership rules have been modified. They use the 318 rules, but modify those. So you have to be very careful about attribution. The other question I saw in the question room or the question box was about option attribution. Options can basically hurt you. They can't help you. And there are regulations that tell you when an option is treated as being exercised. There are tests under the regulations which ask, basically, is the option likely to be exercised? But they go into. So in this structure, we cannot have convertible OP units. Those large former creditors are just going to have to be happy with the interest in the partnership. Another issue that comes up on this one is 311. So when corporation distributes out the partnership interests, it will recognize gain or gain on the transaction, and that'll use up that gain can use up some of the NOLs. It can be a little attractive because it'll increase the basis. If you have a 754 election in place, it'll increase the basis of OpCo's assets, and you can then depreciate or use other amortization methods to claim future deductions. So this structure, what do we say? Don't try this at home. It's complicated, particularly when you wrap it inside of bankruptcy. But in certain cases, it can work to expand the ambit of Code Section 382, L5. Okay, so if we go to the next slide, so that is slide 25. If despite all your efforts, you've not been able to fit within Code Section 382 L5, don't forget about Code Section 382 L6, and this is an elective provision, as is 382 L5. And so what it gives you is it's a different approach to the ownership limit. It's a special valuation rule, as you can see on the slides. What you're going to do is you're going to look at the equity value of the corporation instead of looking at it immediately before the ownership change, think very low because of all that debt. You can look at the value of the corporation after the ownership change when all the debt has been retired, converted to equity, et cetera. And so what 382 L6 will tend to do is increase the equity value of the corporation, and therefore, even though there is a Code Section 382 limit on the corporation, that limit will be expanded and more losses can be used in the future. As usual, there are anti-abuse rules. There's an anti-stuffing rule to keep you from stuffing assets in to try to expand the equity value. So you got to be careful there. So with that, I'm going to turn it back to Remel to talk about other limits on NOLs and NOL usage.
All right, thanks, Tom. So, yeah, Section 269, not necessarily aimed solely at NOLs. It can capture a bunch of things, but Section 269 allows the IRS or gives the IRS the ability to disallow tax benefits, including use of NOLs, if a person acquires control of a corporation or assets of a corporation in a carryover basis transaction, and the principal purpose of the transaction is evasion or avoidance of federal income tax. So essentially, this is a subjective backstop to the other NOL trafficking rules, the 382 rules we've been talking about. There's a regulation that you see there at the bottom of the slide, 269-3D, which is often overlooked, but it basically says that if you have an L5 transaction, so you have an ownership change, part of a bankruptcy plan, but it fits the exception of L5, then that is presumed to be made with the principal purpose of avoiding federal income tax unless the corporation carries on more than an insignificant amount of an active trade or business. Now remember that we said earlier that the COBE requirement in 382, that's part of General 382, is turned off for 382L5. But then this regulation, 269-3D, seems to reactivate an active trade or business requirement. And I guess the conclusion really is that you need a trade or business. It doesn't have to be the historic trade or business. And you get into thorny things like, can you look through to subsidiaries? You look through into a partnership. What's the business of a holding company? And the other thing I'll say here is when these things come up, don't limit the tax thinking or tax research to the field of tax. Tax court cases, that kind of stuff. A lot of the law in this area can be found in bankruptcy cases because generally, if this issue would come up, it might come up as part of the bankruptcy plan confirmation, and it could be dealt with there as a first instance. And so, so just keep that in mind, and if the bankruptcy lawyers are paying attention and if they have a habit of talking to tax lawyers, then what we've also seen in the past or worked on in the past is to have a bankruptcy judge include language in an order essentially to combat this provision and have an order that says there is an active trade or business, or we're not doing anything in violation of 269. So let's look at the next slide. And what we're really doing on this slide is let's look at the ownership requirements. It is surprising how different the various provisions are in terms of what the requirements are. So let's just kind of go through them. They're on this slide. I'll go through them. So regular 382. We're looking at 5% shareholders having increased their ownership of stock by more than 50 percentage points. A 5% shareholder is a person or a group holding 5% or more of the corporation's stock at any time during the testing period. And that means stock other than plain vanilla preferred stock. And it looks to a value test. And so, that essentially encompasses 382, regular 382, NOL limitation 382. Then 382L5, the bankruptcy exception for pre-change shareholders and qualified creditors. There the test is that group of people, the pre-change shareholders and qualified creditors, must own 50% or more of the stock of the new loss company after the ownership change. So that's looking at least 50% vote and value. And just like regular 382, plain vanilla preferred is not treated as stock. And then we just talked about 269, which essentially has the layer on top of 382 to prevent, the use of tax benefits, including NOLs, if there's a principal purpose of tax avoidance or evasion. That looks to control, which is the ownership of stock possessing at least 50% of the total combined voting power of all classes of stock, or at least 50% of the total value of shares of all classes of stock. And so here there's not necessarily a limitation with respect to plain vanilla preferred stock. And so the takeaway here is, you got slightly different wording and slightly different tests for each section and what is required for each section. And so again, it becomes crucial as part of a bankruptcy plan or planning for a bankruptcy plan to weave through these provisions and make sure you meet the ones you want to meet, then you avoid triggering the ones you don't want to trigger. On the next slide, we've kind of put this together in a chart format. I thought that would be helpful. So you got on the left side, the tests we're looking for: regular 382 ownership change, 382L5, the 5% shareholders, 269, and then the bottom one, section 1501-1504. That's the plain vanilla preferred exception, kind of is in 1504A4. And so this kind of summarizes what we just went through. Okay, so let's go to the next slide and briefly talk about NOLs, NOL use, and limitation on NOL. So we've been talking about 382, which limits NOL usage or can limit NOL usage, but it's a layer or potential layer on top of the regular rules, which I guess are in 172, in terms of how are NOLs available outside of 382 context in the first place. So I guess we had the pre-Tax Cuts and Jobs Act rules, and then Tax Cuts and Jobs Act made some changes, and then we'll go into kind of what happened under the CARES Act. So what did the Tax Cuts and Jobs Act do? So for years, taxable years beginning prior to January 1, 2018, NOLs can be carried back 2 years and carried forward 20 years. And they could be used, the NOLs could be used to fully offset taxable income. So it would eliminate any cash taxes you can result with either a refund or a bill of zero. So that's what we'll call, let's say, the old law. Then, and that's the way it used to be for all years. And then, so that's now only for years beginning before 18. Then for years beginning on or after January 1, 2018, NOLs cannot be carried back. So the 2-year carryback is gone, but they can be carried forward indefinitely. So the 20-year cap on carry forwards was eliminated, and the carry forward was indefinitely. But the amount that the NOLs could be used against was limited to 80% of taxable income. So there was essentially, it became impossible, or has become impossible, to completely eliminate a tax and have a tax bill of zero. Now, keep in mind that what this means is that a company that has losses can have different flavors of losses, right? You can have pre-18 losses and post-17 losses. And so you got to track those losses separately, because an older loss can be, would expire after 20 years, but can be used to fully offset taxable income, whereas a newer loss might go indefinitely, but can only be used to up to 80%. I'll just mention, if you're dealing with old years, when the AMT was still there, the alternative minimum tax, you had to have separate AMT NOLs, which are calculated separately. So that's, with the repeal of the corporate AMT, those issues are gone, but could pop up in older years if that's what you're looking at. So then on the next slide, the CARES Act, which was enacted in response to the, the current pandemic, coronavirus or COVID-19 world we're living in. And so what did the CARES Act do? It repealed that 80% limitation for taxable years beginning before January 1, 2021. So it was a provision to help, if you have NOLs, rather than use those NOLs up to 80%, you can use it up to 100% under the CARES Act. It also allowed NOLs arising in 2018, 2019, or 2020 to be carried back 5 years. So it was a method to put money in corporations or taxpayers' hands through carryback and essentially refunds. Now, the HEROES Act, which was introduced in Congress but did not go anywhere. It's not being enacted law. I don't think it was voted on. But that would prevent NOLs from being carried back to pre-2018 years. And as you know, the corporate tax rate was reduced from 35 to 21% as part of Tax Cuts and Jobs Act. And so, the concern in the HEROES Act that was addressed was, well, you're generating a loss, you're carrying that back to an older year in which the rate was higher, and so you're getting a bigger benefit essentially by getting that carryback and that refund. And then finally, the CARES Act clarifies that for taxable years beginning on or after January 1, 2021, when the 80% limitation is in effect, that limitation on the use of post-TCJA NOLs is computed after the use of pre-TCJA NOLs. So it's like an ordering rule, but there was a bunch of confusion after the Tax Cuts and Jobs Act was enacted in terms of exactly how that was supposed to work. And so this is a clarification of the CARES Act in terms of ordering. So with that, so those are kind of the way the NOLs work. Those are the, what I'll call the regular limitations, and then 382, 269 can impose additional limitations on top of, the rules that tell you when you can and cannot use an NOL. And so with that, I'll turn it back to Tom to talk through kind of an interesting situation.
Thanks, Ramel. So as we said, since the financial crisis, there have been a number of developments under Code Section 382. And this is, I think, a very important private letter ruling. You see the number on your screen. And it brings out, when you read it carefully, it brings out some very important legal conclusions for corporate structures. And so we'll walk through it. Now, by the time we're done with this, you'll say, well, what does this have to do with net operating losses in Code Section 382? And about all I say is, but what happened with this structure is the taxpayer was able to reduce its cancellation of indebtedness income and therefore preserve more of its net operating losses than otherwise might be the case. So the way this one sets up, we have a parent corporation, and below the parent corporation, you see business one and business two. So let's focus on business two. And the legal structure of business two was a limited liability company. The debtor in bankruptcy at the top was a parent corporation. It was a corporation for federal income tax purposes. But the legal structure for business two is an LLC. And below the LLC, or inside the LLC, were all the assets of that particular division of the company. And that's not uncommon. We see many times nowadays wholly owned limited liability companies being owned by corporations. And as we know, those limited liability companies are disregarded for federal income tax purposes. Now, the other historic piece about this was the creditors. The way they financed business two was to borrow money at the LLC level. So those creditors owned debt of the LLC, and you can do that under state law, no problem. And, while things were working well, it looked like any other structure. All right. So what ends up happening in this particular case, you can imagine, is that the assets of business two declined substantially in value, as did the business fortunes of business two. And by the way, the entire business. So, the parent company and business two inside that LLC both end up filing for bankruptcy. And so the creditors are looking at an LLC debt, and inside the LLC are substantially devalued assets. And so if, for example, all they had done is sold off those assets and then paid off the creditors, then what would have happened would be the corporation, the debtor would have had substantial cancellation of indebtedness income which would have then perhaps been excludable in bankruptcy. But remember, that exclusion doesn't come without a cost. There's reduction in the tax attributes. So that's one way you could have done it: just sell off the assets, pay off the creditors, recognize a bunch of CODI. Let's go to the next slide. So that's slide 33. So what the ruling shows us is a different way to tackle this problem, and a way that results in a different, substantially different tax result. So what they do with business two is they drop all the assets of business two into NewCo. And NewCo is a box on the slide, as you see, and that's a corporation for federal income tax purposes. So now the next step, and this is all to take the stock of NewCo and then exchange that for the creditor's claims. By the way, the creditors in this particular situation, they were first lien creditors. So they had a first lien on all the assets of business two. And even they were underwater. And the unsecureds and people farther down the food chain were seriously impaired. And the first lien folks were underwater. But all they had were the assets of business two. And again, those are dropped into NewCo, and the creditors get NewCo stock. All right. So what's so neat about this? Well, first of all, one of the things you should look at this ruling for is what is the treatment of debt issued by an LLC that's disregarded for federal income tax purposes. Now, on its face, that might be you might say, well, that debt is recourse. It's recourse to the LLC, and therefore, for tax purposes, particularly Section 1001, it ought to be treated as recourse debt. But the ruling tells us no. That's treated as non-recourse debt of the parent corporation. So why? Because the parent corporation was not liable on that debt. The creditors could go after the LLC, but they could not go after the parent corporation. That's a very important principle that you will see in many, many legal structures where we're using disregarded entities to issue debt. The next part of it is, well, that distribution of stock to the creditors in exchange for their claims, well, how is that classified for federal income tax purposes? And that's classified as basically an exchange. And so had gain been recognized, had it been a recognition transaction, then gain would have been recognized. Now, the reason this is important is the distinction between recourse debt and non-recourse debt. If you have non-recourse debt and you turn over whatever the collateral is to pay off the non-recourse debt, if there's any gain, what would otherwise be CODI, is actually treated as gain from the sale of the asset. And that is a basic tax principle that applies to non-recourse debt. And so you would have gain from the NewCo stock. And so you say, well, what's so great about that? Because I would have had CODI, and now I have gain, so I'm in the same place. And then keep reading the ruling, because the really interesting part about this is that this distribution is treated as a reorganization under 368A1G, as in George. And so that it's also treated as a 355 spin. And accordingly, what you have happening is that that's a non-recognition transaction for federal income tax purposes. So that gain you thought you otherwise would have had is now not recognized, because you've got a tax-free reorganization going on. And again, it's 355. They had an active trader business, distributed the stock to creditors. You say, wait a minute, those aren't shareholders. Right, but they're treated as shareholders for this purpose. And by the way, they own securities. So we have a good reorg under 368A1G, which is a reorganization inside or as a result of a court bankruptcy. So you put all this together, and the ruling basically shows that what would otherwise have been cancellation of indebtedness income is now treated as unrecognized gain in a reorganization, and therefore attributes not reduced, and they live to fight another day. So a very interesting ruling. You have to read it several times to pull these things out of it. But anytime you have a situation where you've got debt of a disregarded entity, if you, first of all, that ruling that says that's non-recourse debt is pretty important. Now, be careful. Take a look. There are other rulings out there that might suggest different results. You got to be a little careful with that. But then also, if you were considering, a reorganization inside bankruptcy, take a look at this technique to try to help you out. All right, so that is that ruling. Looks like we have a final polling question, Shiukay.
We do have a final polling question. So if you were paying attention to the explanation Tom just gave, this polling question should be an easy one. Building on the same facts that Tom's been talking about, what is the consequence when the creditor exchanges the value of his claim for stock in the corporation when the claim is, in fact, exceeds the value of business too? What will be the consequence to the debtor? Tom, do you have any other thoughts on this?
Sure. So how are we doing on our results? Yeah, I mean, again, you see there, the debtor does not recognize gain on the business to assets because the transfer is a Section 368A1G reorganization. So that, I think, kind of concludes the slides. Before we end, though, a couple of things. We got a couple of questions I see on the new big and new bill regulations. What is the status of those regulations? Remember, those are proposed regulations. They're going to adopt the 1374 method we talked about. What's the status? So offline, I got a note. This is from tax notes. That's all I can do for you, folks. I don't have inside information down in Washington. The project on the 382 loss limitation rules remains a high priority item. This is from the IRS. Brian Loss, Branch 4 Senior Technical Reviewer. Remains a high priority item that we continue to actively work on, but there's still a lot of work to be done. Okay, sorry, folks. The government will not predict, and we don't know. But I think what you can tell when I look at the September 2019 proposed regulations and I look at the January 2020 amendments to those, there's a lot of interest. And you can see from our questions, there's a lot of interest in this topic. And so the government, I'm sure, is working on it, but I'm sure they're getting a lot of comments they have to respond to. Now we're just about out of time left, and I promised I'd answer a question I asked myself about 20 minutes ago. Let's say you can preserve the losses under Section 382, for example, 382L5. You come out of bankruptcy, you've got lots and lots of losses. Are those losses worth anything? Our clients they do something very simple. They apply the tax rate to the amount of the loss and say, well, where's my check for that amount? And of course, we all know it's not that easy. And the message here is that it's not that easy. If you preserve all your losses through a bankruptcy, come out the other side, it's not that easy to use the losses. It can be done, however. One important thing, which Remelt mentioned, is that the 382 clock restarts under 382L5 when you exit bankruptcy. So you can bring in a new shareholder for up to 49% in your lost corporation right off the bat. So if you look at the places where this is done successfully, what you end up seeing, it takes a long time because you bring in a new shareholder, for example, a sponsor, a private equity fund, or similar sorts of folks, and they wait. And they wait 3 years, and then they acquire more stock, and before you know it, they own 80% of the company. There are also acquisition strategies. You have to be very careful with those. Basically, to boil all that down, the loss corporation ends up having to buy income-producing assets. And when you parse through the rules, if you do it right, that's okay. You can rehabilitate the loss corporation. So, not easy, can be done. I mentioned Washington Mutual. They came out of bankruptcy with about $6 billion of net operating loss. Their ticker symbol, COOP, C-O-O-P. C-O-O-P is Washington Mutual. It's called Mr. Cooper now. And it's in the mortgage servicing business, earning lots of lovely ordinary income to use against those NOLs. It's a little hard to tell how many of those NOLs still survive. It looked to me like about $1.3 billion or so. And this is what, nearly 10, 12 years after WAMU went under. So take a look at that one. It's a success story in this world of Section 382 and net operating losses. With that, Reynold, any final comments?
No, maybe the only thing I'll say is we've seen situations where 382L6 was preferential to 382L5. So just keep that in mind that you evaluate both alternatives there. It's not always the case that 382L5 is better, even though, on the surface it might look better.
Well, thank you, Remo. Thank you, Tom. On behalf of Mayor Brown and TEI, I want to thank everyone for joining today's presentation, and I hope that everyone have a wonderful day.